I'm Chris Preston,
And I'm Brad Simmerman.
and welcome to Street Check, the best two-person podcast in the 50-plus year history of Cabot Wealth Network. Brad, as if you watched a certain event yesterday, you know dancing robots are the future and are going to be the biggest product in the history of mankind, I believe was the quote. What are you going to use your $25,000 dancing robots for when they're available in supposedly
S-
2 years?
So everybody knows Chuck E. Cheese, right? And the Chuck E. Cheese animatronic band. When I was a kid, we had something called Showbiz Pizza, which also had an animatronic band, and that was like my childhood spot, not Chuck E. Cheese.
Are they
I'm gonna
creepier than the Chuck E. Cheese robots or less so?
No, yeah, I think they were a little bit creepier.
Like when they turn the lights off and you just see them standing there paused in the dark. That was super creepy.
Uh, Yeah, it's all in the same vein.
Yeah.
But I'm gonna see if I can get the licensing and the IP for Showbiz Pizza and try and reopen that. That's what I'm gonna do with my
That's
$25,000 personal robot.
okay.
Reopen Showbiz.
Uh yeah, robots of the future, according to Elon Musk. We'll get to all that. Brad, tell people what else we're going to talk about today.
So this week, as you alluded to, we are going to talk about Tesla's We Robot event last night. We are going to talk about some of the latest inflation figures that have come out. And then we're going to have a little bit of a conversation around earnings and financials. Banks are going to start coming out with earnings next week. So we've got that on the docket. And then after that, we are going to welcome on Carl Delfeld of Cabot Explorer to talk international stocks.
But first, as always, is our defend the take. And Brad, you're up for that this week. And your take, for which you have 90 seconds to defend, is that gold prices have peaked until 2025. You have 90 seconds. Go.
Yeah, first off, I'll acknowledge that gold is up like 1% today, so maybe this is not the best day for me to make the case. Earlier this year, you and I had a conversation around whether we were sort of bullish or bearish on certain sectors. And we were focused on, I think, more gold miners, but I was definitely bullish on gold in general because of macroeconomic conditions. I do think that gold is sort of topped out for the foreseeable future for the sake of simplicity, saying through the end or until 2025, but I'm really thinking more until middle of 2025. Um, Two primary reasons for that, one of which is China is a big net buyer of gold, but they just completed their fifth consecutive month of not increasing their position in gold. Specifically, the Chinese central bank has had really no net change to the amount of gold that they hold in the last 5 months. Their stimulus bazooka that was announced over the last 2 weeks is also incentivizing more investment in their equity markets. So I think that will ultimately have a little bit of a depressing effect on gold buying by Chinese retail investors. And then the other factor is interest rates are creeping back up. 10-year treasury yields are back over 4%. So when you've got a yield environment that is seemingly portending higher rates on treasuries, maybe not for the long term, but for the foreseeable future, that's got some downward pressure on gold prices because gold is not a yield producing asset. Also, as we'll talk about later, inflation does seem to be pretty much contained. That removes a bullish pressure for gold with inflation devaluing the U.S. dollar. So I think we're just sort of at a local top for gold for this foreseeable future, and we're probably not looking at new highs until middle of 2025.
All right. Almost hit the post. You're about 14 seconds over. That's okay. Um, yeah, I mean, I'm just not a big believer in investing in gold in the long term. I think I view it sort of similar. It's a more proven with lower upside Bitcoin, right? Where it's almost the inverse. Bitcoin thrives in bull markets. Gold, now this is a bull market, and gold is thriving. Touching new highs this year. But it's traditionally like a safe haven when there's turmoil around the world, various macro issues, which is that is definitely true. Um, but the fact that that in the long history of gold, that this year it topped out at what, 2,500 an ounce. Is that right? No, sorry, 2,700 an ounce.
Yeah.
It's close to that now. Um, and that's, say, if you bought 10 years ago, when it was also at a, in 2011, it peaked at 1828, late 2011. Gold was a big deal then. If you bought then and held on till now, 13 years,
Uh,
1800 to 26, 2700.
Yeah, I actually happened to, while you were quoting that, I actually happened to pull up the stats. 10-year return of gold as of March was 4.57% annually.
Uh-huh.
Um, Going back to 1971, annual return on gold is about 8%. So
Right.
it lags equities, and it's not
Yeah. The S&P is like 9-10%.
yeah, exactly. So it's sort of a historically laggard. It's ballast in your portfolio, but there are periods in which it's an outperformer, which we've seen this year and for
Yeah.
part of last. And I think that period is I think it's sort of put that period in its rearview mirror where it's not going to be a world beater going
Right.
forward in the way it has been. And the problem with gold is because it's a safe haven asset, if stuff gets bad, if we have more global conflicts, or if the Middle East wars, I guess at this point widens, then you can have immediate pricing pressures there as well. So it's certainly not over the long run, it is a very predictable asset and it underperforms, but in the short term, it can very much feel that fear trade.
Yeah, probably won't hurt you to have gold in your portfolio, but if you're expecting to, you know, get rich quick, gold isn't the way to go, generally.
No,
But I
like
don't want to. We have analysts who recommend it, and at times I think it's a very good. I agree with you. I don't like it at these prices. I don't think it's headed above 3,000. By the end of this year or even next year, frankly.
Yeah, and even if you're like a core holder, I don't mean like a gold bug where you're all in on gold, but if you're like a core holder of gold, you probably don't want more than like 5% of your investable assets
Yeah.
in it because that's when you start paying the penalty for missed performance. I mean, you're always paying the penalty for missed performance, but once it starts taking up 5-10% of your portfolio, then you're seeing material impacts to your overall portfolio as a whole and not just to that one position
Right.
because it's costing you 20 basis points portfolio return if you've got 10% gold over a decade.
Right. Well, we've poured cold water on gold long enough. Let's move on to our big three. Number one, yesterday was the long anticipated Robotaxi event for Tesla. Now, this was on it's quite a production. Hollywood stage is a Warner Brothers stage,
Yes.
I believe. Set and the Cyber Cab, two-door Cyber Cab, which is company's been promising for a while. Model 3 and Model Y vehicles will be available to operate without driver supervision in California and Texas by next year, supposedly. But then there was also something called a Robo Van, which seats up to 20 people, will cost less than $30,000 supposedly, and may be available by 2026. I'll put those in quotes. 2026. Elon Musk famously overpromises and underdelivers. The cyber taxi, or sorry, the cyber. What am I thinking of? The
Cybertruck?
cyber truck. Yeah, sorry. I think it was. How many years was that promised? It finally is. Actually see there's one that lives on my road now, and it's
Is it rusted yet, or is it?
it's hideous, man. Like my 10-year-old son is like, oh, cool, Cybertruck. Is like, yes, but look at it. And he's like, yeah, but on the inside it's supposed to be really cool. Like, yeah, but look,
It I
people don't see
should
the inside.
I wasn't aware we were going to talk about the Cybertruck, but I should disclose I did come across a little bit of evidence, a little bit of interesting information yesterday. If you drive it off road, it voids the warranty.
Oh,
So it's a truck that's not suitable for use as a truck.
okay. Well,
Uh,
that's a good window. I mean, for years you've been promising that. It finally did deliver on that, but the Roadster is still out there. Did he scrap that? I can't
they
remember.
scrapped it. They scrapped the Roadster in favor of the Cyber Cab. Um,
Right.
like I
Which was
sort of
promised in 2019 to
to
be
be two
on the
years.
roads by 2020 or maybe
Yeah,
2021, and still not.
it's at a point where a lot of what is getting promised, including stuff like full self-drive, it's always 2 years away from being 2 years away. It seems to be the
Yeah.
cadence. Um,
And the market is
I
telling you what it thinks of the event.
yeah.
Tesla's down 8%
So,
today.
and I want to one thing I want to flag. DoorDash and Uber are both meaningfully higher today.
Hmm.
So those were two of the companies that there was speculation with DoorDash and Uber that like, Elon would announce a partnership or something like that where, hey, if you're using DoorDash, you can call a cybercab. That there was no evidence of that I saw at the event yesterday. But I
Right.
think what it tells you is that the market is looking at the announcement and looking at the event and saying, no, it's not replacing these two business models.
Right.
Um, that's sort of the assessment that is the most meaningful to me because
Yeah.
Tesla has there are so many long-term Tesla fans and Tesla supporters that it muddies the water a little bit when you are trying to get clarity from what like price action is doing. But seeing the way that Uber is moving today tells me that big money and smart money is essentially saying that they don't believe that this is a viable business model.
Yeah. This quote from Ross Gerber, who's CEO of Gerber Kawasaki Wealth and Investment Management, Tesla shareholder. So I thought summed it up pretty well. His vision is lovely, his being Elon's, but somebody has to actualize it. For now, for the next 24 months, Tesla has to sell EVs. Why aren't we focused on that? And that's my biggest point. He's got to prove it with some of these products. He's talking about turning Tesla from an EV company into a robotics company. Right now, it's still an EV company, and the EV sales have really been lagging the last 3 quarters. I think deliveries just came in very, very slightly under expectations. We'll see. They have their quarterly report in a week or two,
Yeah, coming soon.
coming up later this month. And that's what, I think Tesla stock started taking off in the last couple of months based partly on, anticipation of the Robotaxi, but also because it actually exceeded deliveries. That's when the rally started a couple months ago. People care more about that right now, unless he had a concrete plan to put on, say, hey, this is what these are. They're going to be These are going to be on the streets in the next 6 months. So maybe it doesn't even matter what his timetable would have been because he so frequently says one thing and it's overpromised.
Yeah, it feels very appropriate that the event was hosted at a Hollywood studio because
Yeah.
it felt a little Fantasyland to
Yeah.
me. The
Looked things.
having the prototype roll up and then you've got janky robots serving drinks and like handing out bags. And it's like, okay, yeah, you can do all that, but I don't know if doubling the amount of time it takes to make a drink just to use a robot is justified. I could just hire a bartender.
Yeah.
And
Dancing humanoid robots that mix drinks at the bar will sell for
I,
20,000 to 30,000 a piece. He
well, and
said,
they all
I think this will be the biggest product ever of any kind. Dancing robots that mix drinks.
the other thing is each of those robots had two or three handlers at all times. Um, if he had come on stage with an Optimus robot in the passenger, or I guess there's no driver's wheel. There's no steering wheel, I mean, in the cyber cab. If he had gotten out and then an Optimus robot had gotten out with him and then like accompanied him down the hallway and then had just gone and started serving drinks without the handlers, that would have shown me that the technology is at like an implementable stage where it's like, hey, maybe we're close to production or maybe we're close to being able to use it. But for the time being, it's a fancy novel. It's an expensive novelty that
Yeah.
requires way more oversight than something that a $20,000 robot would need to do. I don't need a robot in my house to fold laundry if I have to hire two guys to watch the robot fold laundry to make sure
Right.
it doesn't fall over.
Right.
So if it's a productivity product, If that's what it's being ultimately positioned as, or a lifestyle convenience, they need to be able to demonstrate that it's capable of delivering on that front in any capacity, and I didn't see any of that.
Right. That all said, could make a case for buying the dip on Tesla down 8%. It's had a nice little run here. That again, the earnings loom the largest. October 23rd is the earnings date. Um, Tesla's, as we mentioned on here, is Cabot's greatest success story, having you know, Tim Lutz, former Cabot chief investment strategist, are recommending it, and Mike Santola recommending it in December 2011. Every time you sort of count it out, it does bounce back, but it does seem a bit of an identity crisis right now.
If my strongest bull case for Tesla is, I think they are arguably one of the best companies at accepting government handouts and government tax credits and government giveaways. I mean, you look at SpaceX, what they're doing there. Um, they're providing satellite coverage to disaster hit areas. I'm sure that there is a paid day there of some sort.
Mhm.
EV tax credits carried them before they could profitably sell the vehicles themselves. Um, there is a value in, especially with the federal government spending as much money as it is right now. If you're a company that is front and center for the federal government when they're looking to hand out money to develop things, that's a huge tailwind. So if you're looking for a bull case, I think that's my strongest one. Like, look, it doesn't matter what their consumer products do if the federal government is going to keep effectively subsidizing them through tax credits, handouts, whatever. And I don't know what shape that'll take going
Yeah.
forward, but they've certainly been big, big winners when it comes to government spending.
Yeah. And the stock has a history, especially in the last 4 or 5 years, of every time people sort of count it out, bounces right back. Happened earlier this year. The stock
Yeah.
dipped. Um, what happened last year, dipped to 113 a share. Happened, this April, 147 a share. It's currently at 220-ish a share, and that's after falling 8%. So it
Yeah.
keeps bouncing back. So chances are it will again, but a lot may depend on, at least in the short term, on the next earnings report. Um, okay, let's get to number two. Inflation. Latest inflation numbers came out yesterday. It's at 2.4%, I
Three.
believe, year over year. Is that right?
It was 2.3%. It's multi-year lows. I think the expectations were 2.4
I thought it was the
for
reverse of that. I thought it came
what
in at 2.4 and
did it?
expectations 2.3.
You might be right. I am
And
going
anyway,
off of
yeah,
what I
it's
saw yesterday.
down. I mean, 2.5% was last month, so it continues to trend down. PPI also came out today, producer price index, and that was slightly lower than expectations.
Yeah,
Um,
the biggest comment that I saw was that PPI shows effectively no inflation. Um,
right.
and
Uh,
then
so I
we
mean,
did,
it's trending in the right, all is well there on the inflation front. And so I guess the question is, how that impacts what the Fed will do next with interest rates.
yeah, it seems to be I mean, it seems to be a question of the job market at this point.
Yeah.
Inflation's doing what the Fed had hoped for. Um, I think what we're seeing is that temporary bump from government spending, from government handouts, and from the demand crush, we'll call it, from COVID lockdowns and stuff. All of that and the supply chain disruptions, all of that seems to be getting put behind us. And now the inflation that we're seeing is coming from a combination of economic strength and from stuff like uh, the green spending and infrastructure spending, where it's just more structural and it's less of a demand spike driving price increases. So I think the question that the market is asking now is, well, what's that going to do for rates over the long run?
Yeah.
Um, and I
So
do
right
think
now,
that
82% chance, according to FedWatch, CME Group's FedWatch tracker, 82% chance that they'll cut by 25 basis points in November, 17.6% chance that there'll be no cuts in November. And you and
and
I,
th-
we were wrong this time. We thought they'd cut 25 basis points,
yeah,
whereas 50. September, and we thought no cuts at all in November, just because it's the same week as the election. November
Yeah.
7th is the date. Maybe we'll be right on that one, but market's leaning, more than 80% now that there'll be another 25 basis point cut.
And there is no expectation of two cuts, which is down a little bit from a month
Yeah.
ago when there was some expectation. Some market participants were thinking that there might be two cuts as well. But job market seems to be strong. Inflation is under control. If we have just some sustained slightly elevated rates and it's not slowing the economy at all, I think it gives the Fed a lot of latitude in how to manage the pace of cuts. Um, I, yeah, I I don't know, man. It seems like the market's at a little bit of indecision point where it doesn't know whether to be worried about inflation coming back or job cuts being too bad or the economy sort of having the wheels fall off. It very much feels like the wall of worry
That's
that,
exactly what I was going to say. This is the wall of worry where things just go up. You keep being worried about something, and then the worries just sort of evaporate. At which point, then we'll probably be close to a bear market, starting a new bear market once the worries evaporate, because then stocks will go through the roof. Okay, let's move on to number three in our big three. Earnings season underway. A couple underwhelming reports today from the bank. JP Morgan was a little underwhelming. How much do you think earnings matter with everything going on? How much do you think earnings matter this season? Because just for a little history, Q2 earnings season, the bulk of which, or the biggest companies reported from around this time in July, mid second week of July through first week or two of August. Earnings were up almost 13%, I think, the best quarterly growth since 2021, I believe. And stocks were down sharply. That was due to other factors, jobs numbers you mentioned. So how much do you think this earnings season matters?
I don't think it matters a ton.
No,
Um,
I agree.
I mean, the part of the problem is that we've got the election and all the other sort of macro events happening sort of
Yes.
right in the middle of earnings season. Um, I am personally watching tech, especially all the AI companies. I've voiced my opinion on that repeatedly, probably much
Yep.
to the detriment of our listeners. But but that's where I'm watching. But in the grand scheme of things, I don't think that this is going to be like one for an earnings season for the record books by any means. I think the focus will be more on what it looks like at the end of the year.
Yeah. The forecast right now is for 7.8% earnings growth, which is good.
Yeah.
But it's not 13%. We got almost 13% last quarter, and it did nothing to move the needle for stocks. I guess you can make an argument that once, the jobs number concerns had passed when the market bottomed in early August and stocks came racing back the rest of that month. Maybe earnings played a role there, but earnings, yeah, they feel like a back burner issue right now.
Well, and one thing to keep in mind, just thinking about it from a fundamental standpoint, um, the market's reaction to last earnings season, which was, great, right? Like you said, is 12.9% year-over-year earnings growth. The
Mhm.
market's response to that in selling off is an acknowledgement that the prices of shares, the equity valuations had gotten a little bit overheated for what the earnings were able to do.
Right.
We're essentially at a point where there's been no net change. I mean, like we're marginally higher, I think, on the S&P. We're about flat on the Nasdaq, and we're
Mhm.
marginally higher on the Dow. That's an entire quarter in which we've had really no net progress, but it is a quarter that is allowing forward earning projections to catch up and to gain ground. So if stocks are up, are trading higher up here, and then but the earnings support only valuation up to like a lower level, you drop the stock price down to the lower level to where the forward earnings support it, and then the earnings continue to grow, that will sort of pull valuations higher with them. So
Right.
it resolves it resolves the same way you resolve any overbought condition, which is either via price or via time. And in this case, prices are about the same, but an extra quarter has passed. So just, spending this quarter and then waiting till next quarter for a new slate of earnings, that can pull valuations higher. That's that's really where I think we're at. I don't think this is going to be a meaningful earnings season for us. Too much macro stuff. Give
Yeah.
it another quarter for value for forward earnings projections to grow, and then that'll start pulling valuations higher. Assuming that we're like fairly valued. I still think we're a little bit overvalued up here, but
Yeah. I think the only way it could matter is if, so I said 7.8% growth expected. If it comes in 1, 2, 3%, like really disappoints, then
yeah,
maybe that could be a drag. But if it's within, I mean, the 13% last quarter was way above expectations and it didn't really matter much. So I think beats won't matter a ton. Other things will matter more, but you know, uh, really underwhelming could be another red flag on top of the jobs number stuff. But I'd be surprised if that happens.
yeah,
Um,
maybe a solid beat and raise. If you get some solid beat and raises in there, I think that'll something
yeah,
that justifies higher valuations. That'll be a needle mover. But
yeah,
if it's a lot of, hey, we're still sort of in line, but we're beating earnings, just not that impressively.
yeah, yeah. Okay, let's now welcome on our guest for today, Carl Delfeld, in just a second. All right, we welcome on Carl Delfeld, who is chief analyst of Cabot Explorer newsletter, which is a global investing newsletter. Which finds, Carl, you found a lot of diamonds in the rough from all over the globe, especially recently. Um, and it seems like it's a good time to be looking outside U.S. borders. With U.S. stocks at or near all-time highs, despite some stagnation of late. There's a lot of sort of undervalued markets out there. And you've talked about the concept of sort of a great rebalancing with money maybe going from U.S. equities into other markets. Talk a little bit about that and
Sure.
sort of where you're looking in particular right now.
Sure. Thanks, Chris. Good to be with you and everyone. Um, the Cabot Explorer is a global service, so we do recommend, well, the majority right now are in US stocks, but we look around the world for value and growth. And I think this great rebalancing is happening this year and will continue for some time because the US, I mean, think about it. The US is 4% of the world's population,
Yep.
maybe 23% of the world's economy or GDP, but we're at a record percentage if you take all the stocks in the world listed on all the stock exchanges around the world, 72% of the capital is in US stocks,
Wow.
which is unprecedented. That's triple our GDP to the world economy. And I think what's happening is the money is starting to flow. I mean, this is not going to be like an overnight thing. It's not going to be a collapse of the US markets. I'm not saying that at all. But slowly and surely, the capital is flowing out looking for lower prices, better valuations. And that's primarily Europe, Asia, and Latin America. And that's what we call the great rebalancing. And it's happening. And I think subscribers who join the Explorer will learn about these new ideas. And a lot of these ideas are very high quality companies.
Yeah, one thing that you've written that always sticks with me is that your company can essentially a company can essentially be headquartered anywhere and do business globally. So
Yes,
it becomes less relevant where a company is headquartered when
right.
you're trying to
Yeah.
anticipate growth.
Yes.
Simply, so that's one thing that's sort of relevant,
Hmm.
or I'm sorry, that sort of resonates with me.
Yeah.
Uh, where what are some of the catalysts that you're looking at when you're trying to identify countries that maybe have an outsized opportunity?
Yeah. You're right. It took me a long time to learn this, but where a company is based, where its headquarters is much less important than where they do business and how they make money. So you can have a company based in London or in Rotterdam or in Tokyo or in Singapore, and they can be in great markets. It doesn't, in other words, it's a global economy, a global marketplace. So I look for like arbitrage opportunities. So one company's in this business here, and their stock price is, I don't know, 40 times earnings, and another company doing just as well, or if not better, in a different country is selling at 20 times
Mhm.
earnings. Well, obviously you want to buy the second stock,
Yeah.
and eventually the market will, the marketplace is smart, investors are smart, and they're eventually going to figure that out, that this other one's a better deal. So that's kind of the way I think. So I look for value and growth wherever it might be, but then you have to check the quality of the company. And the Explorer has two categories. So it's great for all sorts of investors. One are the dominating stocks. These are the big stocks like IBM, Visa,
Mhm.
and so on. They just absolutely dominate their markets. And then there's the stocks that are a little bit more aggressive. I call them disruptive stocks. And those are the companies going after the markets that the dominating stocks control and chipping away and trying to find ways to capture their business. And those stocks can really move fast, and have much higher upside opportunity, but a little bit more risk.
And you've been high on, I won't say a name
Mhm.
of one stock in particular,
Yep.
but a region, Southeast Asia. I know you've been really high
Yes.
on growth there. You've
Yes.
had some success in the portfolio with one
Yep.
stock in particular in that
Yep.
region. What appeals to you about Southeast Asia in particular?
Well, Southeast Asia is, you know, a collection of companies, uh, south of China, east of India. So they're
Hmm.
right in between India and China. And then, of course, the Pacific and the West. So they're right in the middle of it, strategically very important, but they also are all very market oriented, very international, outwardly looking. A lot of foreign capital, overseas capital is flowing into these markets, very strong in technology, very young populations.
Yeah.
Totally, yeah, very young population, fast growing. So there's just everything sort of is going in their favor. And then the other market I'm focused on now, just to bring it up, is Europe, because Europe is trading at a PE, a valuation about half that of the U.S. market,
Right.
which is incredible, given we all know that, there's not much risk investing in Western Europe, but their
No.
companies are trading at a huge discount to the US market. It's less tech oriented, much more balanced. So Europe's another one. And then Latin America is another one in the mining and commodities in particular, which I think's interesting as well.
And of course, those markets don't have the baggage of China. The
Right.
U.S. China tariff tensions and what political
Yeah.
tensions and whatever else is going on there. We had Larry Chung on last week, who's a
Hmm.
Chinese investing expert, who was ecstatic about all the stimulus measures and Chinese stocks are up what at that point 25 to 28%, maybe even a little
Yeah.
more now. I think you're a little more skeptical about not only the measures themselves, but how sustainable it might be on the Chinese
Yeah.
market.
Well, a few weeks ago, as you know, I put out an article which got to the market a little bit late, but basically I felt like the Chinese government was going to do something. I mean,
Yeah.
if our financial markets and stock market are our greatest strength, it's probably China's greatest weakness. They really don't pay much attention to it. Xi Jinping is not really interested in the stock market. He thinks it's a casino,
Hmm.
uh, a gambling, and gambling goes way back in China. The Chinese are gamblers. So they
Right.
don't look at the fundamentals. They're pure momentum players. But when I saw that market was so depressed, I knew they were going to do something. And sure enough, they did. Announced all these government programs to stimulate their stock market. And we recommended a stock which has jumped. We have an ETF in the portfolio. We can talk about ETFs if you like, and that jumped as well. I mean, unbelievably in a week or two. But I'm even thinking about maybe taking some profits less than a month or two after we did that, because I
Right.
don't think it's sustainable. I think I think it's just a short-term fix. So I'm trying to keep an eye on it, but I'm more skeptical, I would think.
Yeah, it's been a big run in
Yeah,
quite a short amount of time. I think Larry said that. What did he say, Brad? He said like so several of his stocks were, I can't remember the term he used for it, but they went from essentially, he was in the red on all of them, and then they flipped to
Mhm.
black,
yeah,
really quickly.
yeah.
And that's you don't see runs like that in this short amount of time very often.
No,
Yeah,
not for big economies. That's what makes
Right,
me nervous. I
right,
would, if I was him, I'd sell some of those.
right. Yeah, maybe.
Yeah,
Brad, you had
yeah.
something?
The Hang Seng was up, I think, almost 30% in a
yeah,
month.
yeah.
Um, it fell almost 10% the day after the Chinese stock holiday and the reopening date. Still up 23% in the last month.
Yeah,
It's up only 26% year to date. So the majority of those gains have all come in the
right.
last month. So there's definitely some
Yeah.
short-term overbought
Well,
conditions.
there's some history here. In 2014, I'm showing my age a little bit, but in 2014, similar situation occurred where the market was very depressed and the government stepped in and you had a rally, very sharp rally, and it lasted some time and then turned around and went down 40%. So it's definitely for speculation, not long-term investors. But China is really struggling. Its economy is really struggling.
You know,
And I will say one more thing about the rebalancing. It's not just about devaluations. There's things happening in the US. I mean, I'm a strong supporter of the US and I'm very optimistic about the markets, but our debt, foreign investors are looking at our debt now over 35 trillion.
Yeah.
This year we're going to have another $2 trillion deficit. Where's it going to end? We have heavy pressure on geopolitical in terms of our defense budget. Everybody, running, we're not going to get into politics, but nobody's talking about cutting spending,
Right.
restraining spend. Everybody wants tax cuts and more spending. And it's making investors a little nervous, I would think, about the value of the US dollar and so on. So it's just really prudent or smart to diversify around the world and not put all your eggs in the US basket. No matter how much you love America, your money should not all be in one market.
yeah, there was an old back in the day when I was a broker, we used to work with, clients that were that had restricted stock option stuff like that.
Right,
And one of the most common talking points was, hey, you don't want all of your investment tied up in your employer, right?
right.
Because of, then you're losing stock value and you're potentially losing income. I
Yeah,
think that something could be said to the same effect for
yeah,
you don't want maybe the economic conditions of your home country to also dictate all of your portfolio performance,
right.
because then bad news is doubly bad.
Yeah, yeah. The one exception these days, I would say NVIDIA. NVIDIA is something, if you work for NVIDIA, you might want to hang on to that stock. But,
Right.
I have a nephew who works for NVIDIA, and I look at him with very envious eyes right now. But
Is
on the
Jen-
other hand, you had Enron, right? A lot
Yeah.
of people in Houston had all their money in Enron, and it
yeah.
was a catastrophe.
Yeah, Jensen Huang is personally worth more than Intel, or his stake in Nvidia alone is worth more
Yeah,
than Intel as a company. So,
yeah.
yeah, if you're a longtime Nvidia employee, you're
I'm
doing
pretty
doing
happy.
quite well.
Yeah.
Now, one of the things that you mentioned was not having like all your eggs in one basket.
Mhm.
I have heard it called a core and explore portfolio,
Right.
where you've got like these core holdings and things like ETFs, and then you're
Yeah.
you're sort of branching out with equities. How do you handle that in Explorer?
Well, I handle it well. There's different ways to do it. You can do it with stocks or ETFs because there's aggressive ETFs and there's very conservative stocks. So, but the one way to think about it is you have your core portfolio. That's kind of your stocks that you're really comfortable with, that you want to hold long term and are more conservative to protect your capital. And with inflation and everything going on in the world, that's important. And so I don't have any magic formula because for each person, depending on their age and their risk profile and how aggressive they are, it's going to be different. But that's sort of your core. which the money you really want to primarily protect. You want it to grow, but primarily protect it. And then around that is what I call the Explorer portfolio. And that's where you venture out. Maybe some of these overseas markets that we're talking about, maybe that's where some of that money would go. And that's where your primary objective is to grow it, to grow your wealth. And one way to do it is have all your core in ETFs, because ETFs are very transparent, easy to use. And so, for example, at the Explorer, we have, I know Chris could tell me, maybe like 7, 8 ETFs we
Yeah.
recommend.
Yeah.
And yeah, and then another way I put it is rifle and shotgun approach. So ETF is like a shotgun. You have all these stocks in this ETF, like a fund. And then you go inside and pick out one or two you like, really, really like. And you buy those stocks. So there's different ways to do it. But I really think, because most people, and listening, maybe they would admit this, when they open up their Fidelity or whatever account, they're just like stocks, 10, 20, 30, 40, 50, 100 stocks in there. And there's no organization whatsoever. And that's not a good thing. So if you can split your portfolios in the core and then pay attention to that Explore, I think investing will be a lot easier for you.
Yeah, to your point, you're right. Your portfolio currently have 8 ETFs and 11 stocks, and that's a good way.
Yeah,
You mix. It's perfect blend of the, what'd you say,
yeah,
rifle and shotgun
yeah,
approach.
yeah.
And speaking of Explorer, so for today's listeners, I do highly recommend subscribing to Explorer. Carl's had some really good winners from all over the globe. For today's listeners, you can go to cabotwealth.com/street and get 70% off the normal price. It's cabotwealth.com/street. We'll put a link for that on the YouTube page. And it's 30-day trial, money back guarantee. So you try it out for 30 days. And if you don't like it, you get your money back. But I think you will, especially at 70% off the normal price. And that there's weekly issues and updates. So you get 4 of them a month. And Carl has great insights. Carl just mentioned briefly just your background.
Mm.
You've been, I know Asia in particular is where you have a ton of experience, but talk a little bit about some of your background, not just in investing.
Yeah.
You have a
Well,
wide,
yeah, I started in banking
yeah.
uh, in London, and then I studied in Japan and worked and studied in Japan, Southeast Asia, all over the world. I worked for the Asian Development Bank with the U.S. Treasury in Washington. I worked with some committees in Washington, so I'm very much into politics and geopolitics. Um, and then I worked with an investment bank covering Japan. So yeah, my strength is Asia, but I follow all markets. Um, and I like stock picking, but I follow the trends. So we try to find a trend sector that's moving in the right direction and pick the best stocks to capitalize on that trend. That's my basic strategy. And I'm looking for, at the extremes, value and growth. And sometimes you can find them together, and
Right.
that's really have a great stock and company to hold on to.
And you're going to be boots on the ground in many of the markets
Yes.
you've mentioned in the next year. I know
Yeah.
you're doing quite a bit of traveling.
Yes, the Explorer is hitting the road, and we're first going to Europe, uh, back back for Christmas, and then in January we're headed to Asia, Southeast Asia in particular. We're going to spend some time in Vietnam,
Oh, nice.
and then ending in Japan. And there's a lot of good things happening in Japan, a lot of good stocks there.
Great. I'm sure you'll find even more in your travels.
Yeah, I hope so.
Thanks again for joining us today, Carl. Always great to get your worldly insights. And again, if you want more from Carl, I highly recommend cabotwealth.com/street, 70% off the normal price for Explorer subscription. Go to that today. Carl, thanks again, and we will talk to you again soon.
Thanks, Chris. Thanks, Barrett.